Good evening. I'm Robert Glauber. I'm a member of the Kennedy School and the Law School faculties. And of course, I have the pleasant task this evening of introducing Paul Volcker, our forum speaker this evening. His talk is the keynote event of a conference on new directions in financial regulation, which the Kennedy School Center for Business and Government is sponsoring this evening and tomorrow. A number of the people in the audience are participating in that conference. I think for virtually everyone in this audience, Paul needs certainly no introduction. He has a long and distinguished career in financial public policy. In the minds of most all of us, he stands among the very smallest group of outstanding public servants in financial regulation and policy in the last half century, defined by his wisdom, integrity, and willingness to say and do tough things. Around here, of course, we're particularly proud to say that he's a graduate of the Littauer Graduate School of Public Administration, which is the predecessor institution of the Kennedy School. And yes, I suppose I should add, he's also a graduate of Princeton University and studied at the London School of Economics. He started his public career as an economist at the New York Fed, served as Deputy Undersecretary for Monetary Affairs at the Treasury in the early 1960s, and was subsequently Undersecretary of the Treasury, then was President of the New York Fed in the mid and late 1970s. He's certainly best remembered as the Chairman of the Federal Reserve from 1979 to 1986, a period marked at its beginning by runaway inflation and posing the greatest challenge to the Fed as the manager of monetary policy. His willingness to put in place the extreme and wise monetary policies necessary to bring inflation under control and establish a stable growth path for the economy define, for many of us, the job description of the leader of an independent central bank. After leaving public service in 1986, he joined and eventually ran Jim Wolfenson's investment banking firm, and over the years has been the obvious choice to run various public, semi-public, and private commissions. He ran the UN's investigative commission examining possible corruption in the Iraqi oil for food program, the euphemistically named Independent Committee of Eminent Persons, established by the Swiss Banker Association, to determine what monies might be owed from Swiss bank accounts to the victims of Nazi persecution. The group of 30 financial policy think tank, as well as a number of other public policy committees and commissions. He re-entered government service formally again last year when then President-elect Obama appointed him chairman of the Economic Recovery Advisory Board. I've been fortunate enough to know Paul from the 1980s. I was privileged to serve during the Bush 41 administration in the same office, Undersecretary of the Treasury, that Paul had occupied 20 years earlier. In fact, Paul and I shared the same executive assistant, a fact that she made painfully clear to me about 1 month after I arrived. She came into my office one morning and said, "Mr. Glauber, I'm not sure you know that I've worked for more than a dozen undersecretaries before you, including Paul Volcker. And Mr. Glauber, you are no Paul Volcker." Well, I wasn't then, and I'm not now, but I'm happy and indeed very privileged now to introduce him to you. Paul.
Thank you very much, Bob. I've always had this mixed feeling about people who are in my old office in the Treasury Department, which I loved, and I have to size them all up to see whether they're up to that job and entitlement to the office. It's a wonderful office. And I'll tell you how things change in Washington, not for the better. I was nominated, I guess is the right word, by incoming President Nixon to be Undersecretary of the Treasury for Monetary Affairs. And upon being nominated, they said, here's your office. And I was there on Inauguration Day, and in that office, you look straight down Pennsylvania Avenue, and I could observe the inauguration parade coming down Pennsylvania Avenue, and people acted in the Treasury like I was Undersecretary for Monetary Affairs. Now they can't get anybody, they can get them nominated sometimes after months, they can't get them confirmed, and the person who should be in that office now, what are we, 9 months after Inauguration Day, a year after election, still not in office. And this has been the most active time for the United States Treasury, I suppose, and since Alexander Hamilton anyway. And it has not been, there are only 2 or 3 people who have been nominated and confirmed and officially in office, and they go through all this business that if you're not confirmed, you can't do anything. Now, they relax that slightly and they let you be in the building, but they don't let you be in the office. And you can't go talk to a congressman. And it's not only true of the Treasury Department, but there's something, it's part of, I think, the deterioration in Washington, which this school is supposed to be correcting, I think, through the years. And that, I shouldn't be, it's not a very happy circumstance. But it's good for my ego to be here, having been in Washington where nobody would accept my ideas on how to reform the monetary, the financial system. I can harangue you. You have a very timely conference here tomorrow. There are very large issues that haven't been resolved. And there is some concern, which I share, that as the markets have improved and Dow Jones average is back over 1,000 and so forth, there are people who say, well, you know, we had a little crisis a year or so ago, but things are getting back to normal. We don't want to be bothered by new regulations and big change. I don't think that's true across the financial markets, but it's true of enough people so that there is some concern that we will not follow through with the degree of reform that I think is necessary. You forget that the market was entirely dependent upon government assistance just a year ago, and in fact it is still dependent upon government assistance in large part, and that is not a sign of a well-functioning, reasonable, private enterprise financial market. There is really something the matter. But there's going to be a lot of discussion about particular changes that are necessary, and I'm sure a lot of debate tomorrow in the meeting, but I think my function, as I saw it today, was to try to put this in a little more perspective, and I'll try to be reasonably short, and we can have whatever kind of discussion you want to have. But I want to suggest that this financial crisis is part of a broader problem. We not only have a financial crisis, financial problem, we have a pretty deep-seated structural problem in the economy. And I'm sure you...
Just stop you for a minute. We have a 6'1" microphone and a 6'8" speaker. So what we're going to do is put...
I thought I was sounding pretty good.
I think you sounded terrific.
In the pocket? Okay, this really, I guess it sounds different now, right? Okay, well, I just want to try to put it in a little perspective, and the point I was making was we have a financial crisis on top of a structural economic problem, and I think they are related. And the structural economic problem, as I see it, is that, well, on the face of it, we had quite a prosperous economy in the past decade up until the beginning of the recession. It looked like everything was going pretty well, price stability and all the rest, but of course we had in total we were spending more than we could produce. And that was largely due to an exceptional demand for consumption. And the result, when you are spending more than you produce, is a current account deficit, which got larger and larger to approach 5% or even more of the GDP, which is a very large deficit for a country like ours. And that, you can ask how it went on so long, and to what inevitably, sooner or later, was an unsustainable situation. Consumption in the United States, which normally was, in a good year, a high year, maybe 2/3 of the GDP, more normally 64, 65% of GDP, at one point got up to 70% of the GDP. And that is a big difference in a structural magnitude in the economy. On top of that, we had a boom in housing, as you know. So this was inevitably an unsustainable situation, and one question is, how did it come about and how did it last so long? Well, this is where the financial markets come in. We've had an enormous burst of ingenuity in financial markets. I think it's fair to say imaginative ingenuity. Whether it was productive ingenuity is another question. But they managed to support collectively the consumption and the housing with a remarkable burst of financial engineering, which was able to turn increasingly bad assets into what were thought to be nominally good assets. And that production kept the housing system going, and it kept the consumption system going. And so long as the foreigners were willing to put dollars in the United States and help keep interest rates low, nobody wanted to change. You could see the problem arising, but it was a rather happy situation. High consumption, growth in the economy. Who wants to interfere with that? Simply because there seems to be some kind of structural disequilibrium, fed by financial ingenuity. When I look at this recession may be over, but look at the prospects for the economy, I want to emphasize that I don't think we're going to have a sustainable recovery from this recession unless we deal with the underlying structural imbalance in the economy. And that means I think we are not going to have a kind of normal business recovery. Normally you have a steep recession, you have a pretty steep recovery. I don't think this time, because we're going to fight the headwind, so to speak, of moving from a consumption-based, no-saving economy into a little less consumption relative to our capacity to produce, and hopefully more investment. And I think we've got to regain, to sound really old-fashioned, some ability to produce goods. Because we can't live, as the Congressman put it today, we're experts at moving money around. But moving money around does not necessarily provide dinner on the table indefinitely. And to just suggest the degree of imbalance we've had in the economy, the finance area of the economy in some recent years has approached, in profits, 40% of all the profits in the country. And that comes after the bonuses. When you measure the profits, it's after the bonuses. If you add the bonuses back in, God knows, it was 50% or whatever. I guess not quite that high. But you can't sustain I don't think it doesn't sound reasonable to me, and I think it is totally unreasonable to think you can run an economy where the finance sector is making 40% of the profits of the country. What is going on here? Somebody's got to someday produce something that we can export. I don't think it's not easy to export entirely, although we try to move in the money. And it's symptomatic of the weakness of the economy. I find myself, I say this all the time, and I don't do it intentionally. I always say you can describe the problem of the economy in one simple little chart, which I will show you, but I always forget to bring the chart along. But I'll describe it to you. If you have a chart of debt creation, debt in the United States, from roughly 1980 until now, a little later than 1980, and you chart the amount of debt in the economy relative to the GDP, you were somewhere around 150% debt outstanding, private debt outstanding, relative to the GDP in the early 1980s. It's now something like 400%. The debt is rising twice as fast or more than the economy. Financial debt, just looking at the debt generated by financial institutions, rose 6 times during this period. We were experts at producing debt, but we weren't experts in producing goods, and it shows. But we're not going to go back to being the major manufacturing hub of the world anymore, but you've got to get some better balance in the economy, I think, than we've had recently, and that's part of the challenge of the financial problem. Now, when we talk about, what went wrong in the financial world, I have a shorthand description there. We can name a number of things. Where were the risk management practices that Harvard Business School was supposed to be teaching, but they forgot a long time ago, in managing finance? I didn't say Columbia Business School. I was careful not to say that. But bankers used to have credit departments. I don't think they have credit departments anymore. They looked at the credit rating agencies. It was AAA, it was okay, or it was AA or whatever. And where were the credit rating agencies? Question number 2. And of course, question number 3 is where were the regulators? Were they asleep at the switch and what was going on and structural problems in the regulatory system? And we could go on with these particular problems, all of which contributed to the crisis. But if I had to summarize it, I would say you had a pretty potent and potentially explosive situation when the compensation in the financial markets became enormous compared to anything we had in relative terms in the past, combined with this new profession of financial engineering, which was based upon principles that said if we can slice and dice, as the expression went, various pieces of paper and put them together differently, we can take bad paper and make good paper out of it. And it's a very comforting thought. If you're running a big bank or something and you've got a lot of money and you want to push that bank to expand, and the people tell you, don't worry, we got the best financial engineers in the country in this thing, and they've figured out how to diffuse the risk, and the risk kind of somehow disappears into the ether. And full speed ahead, as the famous expression by the former chairman of Citibank, while the music plays, we're going to keep dancing. And they kept dancing, and some assurance that, I think, supported by a lot of intellectual effort, that markets were self-correcting and they were efficient, and you will not run a risk of a major breakdown. Well, that proved to be wrong, and things were stretched to an extreme where instead of having a vibrant, competitive financial market, we had a government-supported financial market, pure and simple. The stability of the market wasn't stable. The functioning of the market became totally dependent upon the government. Now that leaves us with the one general underlying issue of reform that is worrying a lot of people, me and anybody that's looking at it, and says, what are the implications for all this government support that was given to the market in terms of crisis, in terms of expectations as to what the government will do in some previous period of strain or crisis in the markets? They rescued us once, won't they rescue us again? And great problem, so-called moral hazard. Will the managers, and more important than the managers, I think, will the creditors of financial institutions subconsciously have the feeling of reassurance that the government will step in and protect them in times of trouble? And one of the interesting characteristics of this crisis a year ago was when the government did step in. So far as I know, I will make a sweeping statement, no creditor lost anything in these financial institutions except Lehman. And the lesson drawn was don't let any of them fail and lose their credit. And they, in fact, some of the actions were motivated. They wanted to save a creditor for understandable feeling, if a creditor lost in one institution, and it did in Lehman, then a feeling of panic would go through the market, and all the creditors would feel uneasy, and you would not have a functioning financial system. And it got to the point where the mantra always was, if you're going to save a financial institution, it's all right, but the management's got to go, and they've got to lose the equity. Well, that didn't happen this time. Completely. Obviously, people lost if they had equity, but they didn't lose completely. That mantra that stockholders were going to be wiped out. Again, except in the case of Lehman, they were hurt but not wiped out. And not every manager lost his job. And some of them walked away very richly rewarded. So it's this kind of hovering concern about moral hazard and whether that will contribute to behavior that will create another crisis down the road. The memories of this crisis will fade. And as I said, some people, well, you know, it really wasn't so bad. We can go back and make some money right away. How do you deal with that problem? And I don't think anybody has a really, there's no perfect answer, because you do have big financial institutions that are highly interconnected in complex ways with all parts of the market. And if they suddenly fail, the repercussions will spread through the market with unknown but maybe serious repercussions on the real economy, as we saw towards the end of last year. Now, I have a particular approach, which I might as well not keep a secret for this audience, and I'll let everybody shoot at it tomorrow during the conference. But I think we are in a situation where the commercial banking system, which in this country and other countries has shrunk in relative size in the financial world, but is still the backbone of the financial system. It is banks that run the payment system. It's the banks that provide a safe place to put your money, liquid money, and that's where everybody wants their money now. It is, you count on banks, and they're not functioning very well at the moment, to provide credit for small businesses and large businesses, and a big problem with small businesses today. They are an institution which I view as primarily a service institution. They are dealing with customers and customers' needs and absolutely necessary services. They're going to be protected one way or another. And we have an elaborate, true for decades, this is no revolutionary idea I'm giving you. Banks are protected all over the world. They have been for decades, and if they're big and complicated enough, they'll probably be protected at a time of crisis. Now, we can prove that system, but I would say, okay, that's a given, but let's not extend that protection to other people. And let's have a pretty clear distinction between those institutions we think are essential to the operation of the economy year in, year out, and those that are off in the capital market, trading in an impersonal way without any particular customer loyalty or relationship continuing. They want to make money by buying this morning and selling this afternoon, or maybe sometimes I guess buying at 10:03 and selling at 10:04, and sometimes making a longer range bet. But that's not an unimportant function, but it's not so central to the continuing viability of the financial system in a time of crisis. So what do we do? Some of those are pretty big and disturbing, and an idea which I agree with, but it's very hard to implement. It's a common idea. It's going to be very difficult to implement. Let's have a system, a resolution process, nice word, that says if one of those big ones gets in trouble, enough to threaten the system, the government can take it over, become a conservator or a liquidator, and the government takes it over, that institution, at least in my variant, will no longer exist. It's not going to be supported, it's not going to be recovered, so that it can be continuing part of the financial system. They're only permitted one mistake. If they fail, they fail. The government takes it over and will make some arrangement to smooth the dissolution of that large institution. So you have a clear institution, a clear separation of the banking function, protected historically and in the future, and an unprotected non-commercial banking part of the financial system. Now, the end result of that is to move more finance back into the financials, into the commercial banks and away from the market. I'm not going to cry about that. I think that would probably be constructive and useful. But that at least is one approach toward this crisis as kind of an overriding, almost philosophical question of how to approach the detailed questions of banking and financial regulation, of which there are a great many, which are not answered simply by that philosophical view. The consequence of that view is I would try to not mix up these functions. Banks should not be doing a lot of proprietary trading. Banks should not be running hedge funds. They shouldn't be generating huge amounts of credit default swaps. That's not their business. That's a business out there in the market of some help, presumably, in fluid and constructive markets, but it's not the hard core of finance that we want to protect by government action. And I would hope the net result is you minimize the chances of a future crisis of the character we have just experienced. Now, that's a very broad-brushed summary of, I think, an important aspect of financial reform. But there are innumerable questions of particular problems. What do you do with the credit rating agencies? What do you do, and very important question, what do you do with all these derivatives? You know, I mentioned how much the debt went up. You know, a year ago, we had $60 trillion nominal value of so-called credit default swaps outstanding, which was probably, I don't know, 5 times as much as there were a volume of credit outstanding. I mean, why did we need all those credit default swaps? They became a kind of trading operation, another way to essentially speculate. Not an activity that needs to be nourished and promoted in my mind. It was all part of this concept of efficient markets and every little thing that we could do to facilitate trading was good. I would simply close by saying we will find, I'm sure many econometricians going to work on this subject, but I cannot detect any connection between the enormous development of the financial markets in the past 10 years and economic performance. I once asked one of the leaders of financial engineering, who I did not know, but I happened to run into him at some conference, and the subject matter in part was financial engineering. I said to him, I won't give you his name, but I assure you he had a Nobel Prize at least, and more than one that has a Nobel Prize. I said, what's all this financial engineering do for the economy? What's it do for the productivity of the country? Much to my surprise, he whispers in my ear, nothing, which was not the answer I was expecting to get. I said, what does it do? He said, it moves around the rents in the financial markets, which it certainly does, and besides, it's intellectually a lot of fun. And I tell you, the rewards in this area and the intellectual challenge, the true intellectual challenge that it has attracted so much of the best talent. And I'm sure the Kennedy School, surprisingly, as well as other places, more directly involved. And you wonder about the relationship between the siphoning off of so much of our best young talent into finance instead of into other sectors of the economy. So that is something I worry about in terms of our future economic growth. And with that encouraging statement about education, I think I will stop, Bob.
Which leaves us a good deal of time for questions. There are probably as many questions as there are people in the room. We have 4 microphones, so if you will approach those if you have questions. Please identify yourself, limit yourself to 1 question, and please try to make it a question. Sir.
My name is Michael Brower. Like you, sir, I studied at this school before it was the Kennedy School. It was known as the Littauer School then. One structural issue in our economy that you did not mention is the rapid increase in concentration over the last 30 to 40 years of income and wealth. Today, our country has a more concentrated economy with the wealthy holding more power than any of the other wealthy countries of the world. Today, the top 2 or 3% of wealthy people control more wealth ownership and receive more income than the bottom 80%. Sir, what role do you think that played in the worst economic crash in my lifetime since 1932? And what role do you think reforming that and making our society more democratic and egalitarian would play in avoiding a future crash?
Well, you know, I think it is a real problem. We had a situation in which the average working man, or whatever the right characterization is, in the economy for the past 10 or 15 years has shown relatively little and maybe no real increase in income. At the same time, obviously there's a sector of the economy up at the top that has enormous increases in real income. And the differential, as you say, has gotten bigger and bigger. Now, there are various attempts to explain that, whether it's through the open markets, open trade, foreign competition, whether it's because of changes in relative education attainments by those at the top and otherwise. I'm sure those are all factors, but I think what we're seeing is that's partly a reflection of this great expansion on the financial side, an activity that is not very well related to production in the economy. And I find, maybe I'm old-fashioned, but I don't know how many of you saw the story in the New York Times a few days ago about the Simmons mattress company. And it started out, I don't remember the figures exactly, but Simmons had been a profitable and a leading mattress company in the United States for years. And 10 years ago, roughly, it had been going along and had something like $150 million worth of debt. In the past decade, it has been bought and sold 4 or 5 times by various private equity companies, and it ended up with $3 billion worth of debt and bankrupt. And the kind of sad part of it is some thousands of workers have been laid off, and they interviewed the last equity guy who had it. He said, you know, it was a pretty good investment. I took more money in fees out of that company than I lost. So I came out with a profit. Now multiply that may be an extreme case, but multiply that kind of driving behavior where there is that enormous profit motive in basically leveraging these companies at great risk to the company, but the guy who does it hopes to come out free, and many of them did come out free. How much of that talent you know, I am chairman of this President's Economic Recovery Advisory Board, if I get all the words correct. And a couple of people on that board have pointed out to me, which I now see more easily elsewhere, that in a number of areas, and in this case, particularly thinking of the opportunities of the so-called green economy and what needs to be done in innovation in industry and elsewhere to promote clean energy and all the rest. The United States is a leader, intellectually, has been a leader in wind power and in solar panels. I don't know whether either of those are really going to solve the energy problem, but that's beside the point I want to make. While the United States was technologically the leader, there was only one company in the United States that makes windmills, and there are about 6 around the world, so we import most of the windmills we use, and the same thing with solar panels. Now, these are not heavily labor-intensive manufacturing. You can't blame it on wage costs. And in fact, you can't blame it on wage costs at all when we're competing with Europe, which has basically the same wage costs we do. How is it that somehow the manufacturing has slipped away even when we were primary in the technology of it? And somehow that's got to change.
Hi, Mr. Volcker. My name is Matt Davidson. I'm a student down at MIT. I wanted to ask you, you mentioned this mountain of debt that we've been building for the past 30 years. This reminded me of something that Ludwig von Mises said. He says that there's no way to prevent a bust of a boom that was brought out by credit expansion. So if you have this credit expansion, you're going to have a bust eventually. And the end result there is a failure of the currency system involved. And I was wondering, do you see this danger to the dollar, and what do you think that we can do aside from perhaps going back to a commodity standard?
Can I spend so much time in the Treasury and the Federal Reserve, automatically when you say, what's the future of the dollar, I clam up. I think it is a concern. A byproduct of this structural problem we have in the economy is this big pileup of dollars and other short-term dollars, mostly Treasury securities in the hands of other countries, and particularly their own central banks or other official institutions. I keep forgetting the numbers exactly, but I think foreign countries own about half of all our Treasury debt. And the Chinese alone, I guess, have something like $1 trillion worth of Treasury and so-called agency debt. I mean, these are pretty big numbers, and it's not entirely unexpected that they begin saying, well, we got all these dollars, I wonder how good the dollars are. Now, on the other hand, they have a great interest in the stability of the dollar because they own so many of them, so I don't think they're about to go off on some rogue expedition and depress the dollar because they got too much to lose. But it isn't the most solid situation in the world. And it's something that should worry us, and it should propel us to try to make the corrections in the situation that I mentioned. If there is, we still are the biggest country. There are tremendous advantages in having a world currency. The dollar is the world currency. So out of custom and convenience, it will, I think, remain the world currency. But we have to pay attention to the fact that we have certain responsibilities. We want that. One is to maintain price stability. The other is to watch out for too much debt creation, and certainly not to keep running the kind of deficits internationally that we've been running. So, we have, another subject. Everything reminds me of everything else, but you're conscious of the fact we have this huge budget deficit, which worries people from the standpoint that you and others raise. Worries people for other reasons, and I think it's true that we are on a trajectory that within a few years could produce Treasury debt equal to the GDP, which is a number we've never seen except at the end of World War II when it was kind of artificial. It came down right away. But what do you do about it? We are now still in high levels of unemployment, slow economy. Nobody's going to propose increasing taxes or reducing expenditures in any vigorous way right now. So people say, well, we're going to do it next year or 2 years or 3 years. I think the administration clearly understands this is a problem. But how can they be credible about what I think is their intention? I think they understand it. They want to do something about it, but they can't do anything about it now. So you got to believe them on faith. And they are conscious that this problem of relying on faith is a problem, but I don't think they have a solution to it. And I don't have a solution to it either, frankly. But
Yes, sir.
Yeah, my name is Bezo Enwebara. I'm a graduate of MIT. My question is this. In the 1970s, Nixon removed the dollar from the gold standard. And because of pressure on the dollar, because of the Vietnam War, and because of the rising economy of Japan and Germany. And in the 1980s, when you were in office, you were responsible for the Monetary Control Act of the 1980s, which actually destroyed the ability for the nation to save. Today, as a result, the United States set in motion is a printing press. I mean, the dollar you were printing as much as you wanted. Nobody was controlling because everybody was enjoying. Of course, others were paying the bill. Today, those who were paying the bill are saying, we're no longer going to pay, not only that we're no longer going to pay the bills, we have found an alternative, which is the euro. So today, all the countries that are producing, yeah, my question is,
Mr. Glau, I'm not worried about the legs. My hearing isn't so good. Mr. Glau is going to have to translate this to me.
I can't do it is we haven't got a question.
my question is, given that most countries that have a lot of reserve with the United States are about leaving the dollar for the euro of another currency, especially OPEC, how does America going to control that movement from dollar to euro or other
Yeah, well,
currencies
okay, yeah,
as
look,
a means of exchange?
Yeah, I understand the question. What's the risk of people moving out of dollars and other currencies? And it just supplements the question we just had. And one of the answers is the really big holders don't want to upset the dollar. But then they look at it hard-headed way, where are they going to put their money? Now, I can understand worrying about the United States and the deficits and all the rest, but they say, okay, shall we put it in Europe? I mean, Europe doesn't look so great at the moment, and they have all the tensions within the Eurozone, with some countries very weak and other countries strong, and they don't have the same developed markets, so I don't know whether and I'm putting myself in their position. I don't know if I want to put all that much money in the euro. So where do we put it? Well, the yen. How about the yen? Well, you know, the Japanese economy hasn't been doing well at all, and the yen has gotten pretty high in value, even relative to the dollar. Maybe we can't put too much in the yen. Well, those are the two principal alternatives. So maybe I'd like to put it in the RMB, but the Chinese won't allow that. So I'm sure they sit there and talk about it, and they say, well, maybe we better keep it in the dollar for a while. I think that's where we are. And I do think there is a case, but I am really idiosyncratic in this, that what this whole period of the past 10 or 15 years shows is we don't have a sufficiently organized international monetary system. There should have been something out there that enforced a discipline, to be specific, both on China and the United States, to rebalance their economies in a way that was, that if not eliminated, narrowed these deficits in our trade. It just, but there was nothing out there. It suited everybody's convenience at the moment, and there was nothing to stop it until you had the crisis when it's too late.
Hello, my name is Mark O'Connor. I'm from a group called We Are Change. Under the Logan Act, it's a felony for any member of federal or state government to meet with members of foreign government without the express authority and authorization of the President or Congress. Being that you have attended on presumably numerous occasions the Bilderberg Group, can you explain why that may or may not be a violation of the Logan Act?
This is,
The Bilderberg Group, and you're attending it as it applies to government officials, right?
the
Yes.
Bilderberg Group.
Yeah, but presumably Mr. Volcker wasn't attending as a government official.
Okay, then do you plan on attending during your current administration? And what?
I've only attended the Bilderberg Group. I did attend this year, I guess, but it's only about the second or third time in 30 years I've attended it, so I won't take responsibility for all of it, but I don't think it's a secret. Well, they like to meet privately, but it's not in the nature of a secret society. These people like to get together and exchange views, and it's pretty benign, I think, actually. I don't think they're controlling the world for better, probably for better.
Yes, sir.
Sir, you early in your talk mentioned concern that the 60% rally in the market would undermine the sense.
Ask you just to identify yourself.
I'm sorry. I'm Vincent Stanton, a retired investment counselor. You spoke about the fact that the 60% recovery in stocks might undermine or postpone the sense of urgency for reform of the financial system. The question to you as a man who has spent a lot of time in Washington is, even if the market had not rallied, are you confident that with all the forces of lobbying and so forth, we could get well-reasoned reform of the system? Or do the lobbyists have full sway over there? You've got a lot of years there. Would you evaluate that?
Well, it's putting a tough test on Washington to say well-ordered, comprehensive reform, or whatever adjective you use. But I think, yes, there would have been, I think it's still promising that we'll get a pretty good reform program, but it's not going to be so easy. The toughest problem, the underlying problem, I think is the one I mentioned. And how do you deal with this so-called moral hazard problem? But there are a lot of particular things that need attention, and I think we'll get attention. Now, there's some risk if you want to go the other way. Dealing with this crisis required extraordinary action, both by the Federal Reserve and the Treasury, and by the FDIC, just to widen the circle a bit. And if you had gone 2 years ago and said, does such authority exist in the Treasury? Does such authority exist in the Federal Reserve? Does such authority exist in the FDIC? You would have been hard-pressed to find, Article 3, Section B, that provided that. So there were some rather sweeping interpretations of existing legislation, which has now created a reaction. And people say, what was your authority, and didn't you exceed your authority, and we're going to cut back. It's one strand of thought. I don't think it's a predominant strand of thought, but it's there. And particularly in some circles, there's a very anti-Federal Reserve reaction, which I think it could reach dangerous proportions, because I think it's a very important institution. And it is the one institution that has the capacity to respond promptly within its mandate to this kind of crisis situation. And if you take away all their flexibility and all their authority and tighten down on the Treasury and raise your eyebrows at the FDIC when the next crisis comes along, I don't want to leave the government with an inability to react. So I think we have to take some chance in providing the authority or not taking it away. And part of the solution, I think, has to be procedural. Can the Federal Reserve act on its own, or should it get concurrence by the administration or by the Treasury? If you take some of these extraordinary measures to deal with non-banking institutions or banking institutions, should that be a decision of the Federal Reserve Board and the FDIC and the Treasury? So you get a three-layered kind of procedural safeguard, and I think the answer to that question is yes. We ought to have a variety of procedural safeguards when they're using extraordinary authority. But if you take away all their flexibility, we would have really been in the soup a year ago. So I want to protect that.
Thank you for joining us again this evening. My name is Adam Chetnik. I'm a dual degree student here at the Kennedy School and at Harvard Business School. In the audience tonight are a lot of students, and I'd be interested to hear your perspective on any lessons that we've learned from the financial crisis that young people like myself, who will be entering the job market soon, should try to apply to prevent the crisis from happening again in the future.
Well, the first lesson to learn, and memories are very short, is that financial crises exist. And conduct your personal and business affairs with the knowledge that a little attention to the risks involved is appropriate. I do think, I say only half jokingly, it was only a quarter jokingly and 3/4 seriously when my oldest grandson informed me, as a brilliant young Princeton student, that he wanted to become a financial engineer. My heart sank. But it was typical of that generation. And I wish more people, and I wish the business schools and otherwise would somehow try to inculcate in the students the challenge of a non-financial world, which obviously making things, taking that technology and producing something real can be as much a challenge more than making $1 million in the financial markets. And I wish that was better reflected in the educational system and in your career choices. And my grandson happily decided he didn't want to become a financial engineer anymore, so I don't know where he's going to end up. There isn't any doubt that we put too much of our energy and capabilities in the world of finance.
How you doing, Chairman Volcker? I'm David Escamilla. I'm a senior at the college. I'm actually writing a thesis about GlassSteagall, and you alluded a couple times to perhaps bringing it back. So I was curious what your thoughts are about GlassSteagall and specifically commercial banks during the course of the 90s and their entrance into riskier fields.
Well, GlassSteagall, in my day, prohibited two things. It said a commercial bank could not underwrite or deal in corporate securities. We had some minor exceptions. I'm not against banks in the underwriting business. I think it's so close to their lending business, so close to securitization, that I think it's an artificial distinction, too artificial to say they can't do underwriting. I'd permit them to do some trading connected with the underwriting, but when you go beyond that, I guess it's the philosophy of GlassSteagall. I don't think they should be heavily engaged in risky capital market activities which compound the risks that are inherent in commercial banking anyway, which are enough. I think it's distracting to management, it is hard to manage, and for any commercial bank that has an active investment management business, which many of them do, or investment advisory business, enormous conflicts of interest arise if they're running hedge funds and equity funds at the same time and doing a lot of proprietary trading. You can't avoid it. And I think it's just an unnecessary accoutrement of the financial system that we can do without. Let somebody else go do the hedge funds and the equity funds and for all the nasty comment I made about equity funds, in concept, providing capital for small businesses or medium-sized businesses and providing management assistance is a desirable thing. If all you're doing is leveraging them for a quick turn, that's not a desirable thing. But it doesn't go comfortably with protected commercial banks. Let that go to the unprotected sector.
Good evening, Mr. Volcker. My name is Vilas Rao. I'm a student here at the Kennedy School and previously at the Philadelphia Fed. My question is about the macroeconomic research that takes place at universities like this one, which seems to be quite disconnected in general from the policy challenges we see today. For instance, we see plenty of research on business cycle modeling and not very much on the effectiveness of fiscal stimulus or monetary policy at the zero bound. Why do you think this is, and how do we bring cutting-edge economic research to apply to the challenges we see today?
Well, I'm not sure I fully grasp the breadth of that question, but
Much of the research that goes on here is not particularly related to the problems.
Okay, because that was going to be my answer.
What to do about it?
I once considered myself an economist. I don't know what I do anymore, but that was literally, 60 years ago when I took economics. And it was not at that point much. About that time, Paul Samuelson he didn't got the Nobel Prize later, but his great contribution was making economics more mathematical. Well, I was aware of it, but I was not part of that process. But I do think the profession of economics has gotten pretty far removed in our best graduate schools from the real world. And it has not been very scientific in the sense that it's been very accurate in predictions, which is one test of whether you've got a good science. Now there's some reversal of that recently. We give Nobel Prizes in economics to people who aren't economists, which is probably an advance. But you know, they're bringing back psychological and human behavioral elements into the world of economics, which I think it never should have left. But I think that is kind of a constructive development in the world of economics. You know, you're hearing all my prejudices when it's a sign of age, but economists tend to think that they own the Federal Reserve. I mean, you know, it deals with the economy, we're economists, therefore we ought to be running the Federal Reserve. And there's a very strong feeling of proprietary interest assumed. I think that is a mistake to put it simply. If the Federal Reserve Board had nothing but economists, I think it would not be in very good touch with the real world and arrive at appropriate judgments that should be fertilized and influenced by some sense of what's going on in markets and in the economy generally in ways that a really highly mathematically trained and dedicated economist may not realize. I mean, you need some economists, there's no doubt about that, but I'd like to see a Federal Reserve Board that has, you know, has some economists, but has a banker or two, that helps, a businessman or two, maybe somebody from other public life in some respect, somebody with broad experience, so that you don't get too insulated, in my view, from what may be going on in the world. It shouldn't be a college seminar. It's a policy-making institution. And I guess that's my answer to your question.
My name is can you hear me? My name is Frances Gladstone. I'm a published writer here and in France, a novelist, and I teach at BU and the Sorbonne. I'm trying to speak close to the mic, okay? This is more positive. About 4 months ago, because of all the cries of misery and starvation that the government has, I thought of a very simple strategy by which you people, meaning the federal government, could raise, say, $500 million, $1 billion more a year. It's patent pending. Every time I try to reach the government here, I'm stopped, or someone says, tell me what it is, I can't go forward. And I really don't know. I think it's only maybe $1 billion a year, but over time it would help. Where do you suggest, or what do you suggest I do?
The question is,
where you should go to deal with the patent.
No, not the patent, just which part of the government, or which, specifically, how do you contact them?
Susie?
Let us talk the afterwards, but I don't think.
Well, shouldn't he be the
There's
one
something
to
I'm not
decide
the
that?
expert on this. There's something I'm not a self-professed expert on.
Well, I was gonna say, but if you'd like to.
No, I didn't understand.
Thank you. My name's Diane Schipione, and I'm a mid-career student here at the Kennedy School.
You know what?
A mid-career master's in public administration here. Chairman Volcker, you're a great hero of my father's, my late father, so I want you to know that. I have a question, though, two questions. One, what are your thoughts about removing the prohibition to short on a uptick? And then second, a recent report came out indicating that the banks are sitting on about $825 billion in cash, as compared to maybe $1.1 billion last fall and $1.2 billion the prior fall. And so is that occurring, do you think, because the banks aren't lending, because people aren't wanting to borrow? And what will be the impact when that cash is suddenly released into the market? Could it potentially lead to an inflationary response?
Well, if I understand all the questions, two questions. On the uptake rule, a very technical question. You know, the people here know more about that than I do, and you know, on the face of it, it sounds sensible to me to not permit or encourage in crisis situations, cascading, short selling, building on itself. But I don't think it's quite that simple because there's so many ways of trading now and so many ways of going short. Stopping it on the stock exchange may or may not be very effective. But I'd leave that in the hands of people that know more about it than I do. The water question now was,
The other one is
I really am getting old.
the bank's liquidity position.
Oh, yes, and you know, whether people are refusing to lend or people don't want to borrow. There's a lot of both, I think. You know, both. The banks are shook up, and particularly if they're in a weak position, as many of them are, but many of the borrowers are shook up too. So you talk to the bankers and they say nobody wants to borrow. You talk to the borrowers and they say no bank wants to lend. And there's some truth in both of them, I think. But meanwhile, you've built up this tremendous storehouse of liquidity. There's no problem with shortage of liquidity, a lot of cash sitting around. And that presents a very real challenge for the monetary authorities as we move ahead. It's not inflationary at the moment, precisely because nobody's willing to borrow, lend, or spend. But at some point, that will change with recovery. The hardest thing in the world, there are a lot of things that are the hardest thing in the world, I guess, but for a central banker, adopting a more restrictive policy in a rapidly growing economy, but it's still an economy with a lot of unemployment and operating well below its capacity, is very difficult to do because the public will say, what are you doing tightening up? We still have a lot of unemployment. And I assure you the politicians will be saying that, and the president probably will be saying that or thinking it, whether he says it or not. And the Congress will be saying it. So you've got to act at that particular juncture against what a lot of people think with common sense. But if you don't do that, you're likely to be too late if you wait until the inflation has actually gotten underway and the economy is generating new bubbles and it's too late. So that is the challenge in very general terms that they are going to face in the next, I hope they face it because it means the economy is rising. But that's the real test of the federal, you know, the famous statement that one of my predecessors, William Shackling Martin, made, you got to take away the punch bowl just when the party's beginning to get good. He didn't say take it away after they're already drunk, right? And that's the real challenge. And it's a particular challenge now, both because the recession is so bad, you have this underlying structural problem, and the liquidity buildup has been so great that it's going to be a real management challenge.
Let me take two more questions, and let me take them in order. Yes.
Chairman Volcker, thank you so much for coming. My name is Pratik Kumar, and I'm a junior at the college. I was wondering if you could speak a little bit more about credit derivatives. I know you mentioned them briefly in your talk, and prior to the abuses that we saw of credit derivatives in 2005, 2006, 2007, we saw that credit derivatives could be useful in an economy, whether you're using mortgage-backed securities for residential homeowners or using credit default swaps to insure against default or bankruptcy. What role do you see for credit derivatives going forward in the economy, and to what extent should the regulatory framework for these financial instruments be changed?
Well, this is something that is going to have to be part of the reform effort. It's an area that I don't pretend to great expertise, but you do have this kind of dilemma in approaching it. This is a classic kind of technique, of which there are many in financial engineering, that on the face of it says, okay, this is a convenient, efficient way to protect against a certain risk, a bond you hold that might go bad. And looked at from that individual standpoint, it looks, there's no reason to prevent it. It's a kind of insurance policy, and it may be constructive. But does it turn into a different kind of animal when it becomes dominated not by people who are genuinely protecting against a particular security that they may hold, but they're betting? It's another way of playing roulette with the markets, and maybe a very efficient way from the standpoint of a trader. But then when things went bad in this particular case, we found out that the protective mechanisms, whatever they were, the collateral requirements, the margin requirements, were ineffective or insufficient to prevent the danger of a kind of cumulative collapse of these trillions of dollars that were sitting out there and too much uncertainty about how they would repay. That may have been overdone, but it was very real. I think we will definitely see some changes there in forcing more of these derivatives of all sorts, including credit default swaps, onto organized exchanges where you have built-in protections against default. And it probably will mean less, but that's not going to harm anything if they're less than the extreme volume they got. And a lot of that volume was froth, and when they sat down and kind of tried to cancel out each other's obligations, you found out the 60 trillion was a mere 30 trillion or 25 trillion. And I think we can get along with a lot less than that. Now, the extreme proposal, probably worth debating, say, okay, you can use a credit default swap if you have the underlying instrument that you're protecting, but you can't go buy them, you can't buy protection against something you don't have. And that's the most draconian approach. I don't know enough about it to know whether that makes sense or not, but I'll leave that judgment to somebody else. But there will be a forcing of more of this under the exchanges, which I think is constructive. Same time, you're going to have people say, well, okay, you can force them on the exchange if they're more or less uniform, but you can't force my very complicated special one on the exchange because there's nobody to trade with. And the more you force on the exchange, the more they'll say, well, mine is special, and I don't want it on the exchange. So it's not easy to control it. You can't control them all. And this is, I come back again to the underlying question. If the firms dealing in these things really are convinced they're not going to be protected in time of crisis, they won't be so adventurous in doing so much of the business, is the underlying theory, and I think we have to rely upon that. They've had the experience of a crisis, and if they become convinced that they're not going to be bailed out, to use the cliche, they will presumably handle all this more responsibly.
Take the last question.
Chairman Volcker, thank you for joining us tonight. My name is James Wynn, and I'm an MPP student here at the Kennedy School. My question to you is in regards to asset bubbles. What lessons can you draw from the financial crisis that would have you think about the Federal Reserve playing a more active role in both identifying and intervening to deflate asset bubbles?
Well, I would say, and this is just a personal view, obviously people have different views. I think these bubbles are hard to identify, particularly in their beginning form, and when they get very extreme, again, it's too late. But I would not be a complete pacifist in terms of a sense of a bubble arising. There's probably a limited amount you can or should do in terms of general monetary policy. But if you really see it broadly enough, as I think was the case in subprime mortgages, you have a case for making money somewhat more restrictive than you otherwise would. Now, whether that would break a crisis, break the bubble in the mortgage market or in the stock market is always problematical, but I think the Federal Reserve or the monetary authorities ought to have other tools that they could use. And they should have had tools to deal with the subprime mortgage market. Now, a lot of that was outside of the purview of the banking system initially. But this is an interesting phenomenon. I just look at it from outside. But the subprime mortgage was practically unknown 5 years ago. And it went from 2003 or 2004 to $1.5 trillion in the space of about 3 or 4 years. And the regulators obviously didn't catch up with it. A lot of it took place, I'd say, outside their immediate purview. But if they had realized it, and I think they've learned their lesson, and if you had one of the strong proposals for reform is to have some kind of an overseer that's looking at the market outside particular institutions and try to see whether they see emerging bubbles or emerging trends that will be destabilizing. They could go in and take action outside of the immediate responsibility for the safety and soundness of a particular bank or other institution. And we have lacked that. We lacked enough sensitivity. So I think there are things you can do, but there's no, it's not entirely a monetary policy question by any means. But regulatory policy or supervisory policy, I think, can help, and we ought to be alert to it.
With that, I've got to bring the proceedings to a close while I speak to everyone.